All right, guys, welcome back. And today we're going to talk about our biggest loser, which is CONY. Now, for those of you who don't know, CONY is a fund based on Coinbase offered by Yieldmax. Now, originally CONY was flying high, doing great. I'm just going to be honest, it had a decent distribution showing, did pretty well. You could pretty much bet on about $1 a month or every 4 week cycle as it is now. But the truth is, if anyone tells you they don't lose somewhere, be it in business, stocks, anything, I'm not going to say they're lying, but they're not being truthful with you because everybody takes losses. Now, at the same time, as a whole, their business or as a whole, their portfolio could be doing so well that it offsets those losses. Some will even include using tax loss harvesting. They're like, well, I saved that money in taxes, so I didn't really lose it. Or some will say, well, I haven't lost any money because it's on paper and I haven't sold it yet. It might recover. But I'm going to just tell you, in any of these forms, there's a loss somewhere, and this is ours. So to put in perspective, we have 1,500 shares of CONY in our individual accounts between me and my wife. We do have some other in our retirement accounts, but it's negligible at best. So as we've been going, the distribution and the share price have just been chugging down the hill. I mean, first, the share price goes on these covered call funds, and they can't recover fast enough. And then the distribution starts to go. Now, if you're lucky enough, you may get a rebound. I mean, we've seen this out of other Yieldmax funds like Misty or Platy. You know, they will bounce back up and recover, and the distribution recovers with them over time. Now, CONY being based on Coinbase and as beat up as that underlying is, it's going to be a while if it does recover. I'm not saying it won't. I just realized the reality of what it is. So it leaves us some choices here. How do we handle this situation? As I mentioned earlier, some people could play a game with tax loss harvesting. Some people could sell covered calls on the shares, trying to create premium to offset the losses. Another option would be just sell. Get out and sell. That's what a lot of YouTubers will tell you. There's nothing wrong with that if you have something else to put it in that will equal or benefit, but you still are taking those losses. You are locking them in. It is real. Other people might tell you, hey, just keep collecting your premium, get your payoff, and then whatever you get after that is just gravy. Nothing wrong with that either. But I am not one to do any of those things generally. I like the thought of how do we fix this? Now, the strategy I'm going to employ is a temporary one because it ticks a lot of boxes of how I like to invest. Our current plan is we're going to take our distributions from CONY and reinvest them in Platy, which is PLTY, which is the underlying Palantir, but it's a fund offered by Yieldmax. Now, why are we going to do this? Well, number one, it takes one step off of what I've got to do with this cash. So I always reinvest something, anything. I have to constantly reinvest. It's just me. In order to know I will never run out of money or we will never fail, I constantly reinvest a share, a section, an amount. It isn't really relevant what percentage it is or what dollar amount it is. I don't get that technical. I just need to be putting money back in to grow at all times. That's just me personally. So that's one thing I will now not have to do for a while, because as we reinvest these distributions, it will help the account grow or at least maintain. All right. The second reason is we've seen, much like MSTY, PLTY can have share price recovery. We saw it go through the dip. I actually bought a bunch of it down there, and it has since appreciated quite nicely. It actually currently in the market today dipped again and is now recovering after its underlying missed earnings. So this is a real good sign that this fund can hold up over time. It's not a guarantee, but things look better as far as we can see. Now, the distribution rate on it has fluctuated anywhere between like $2 and $5. I mean, when I estimate my distributions off of it, I only look at it from its minimum payment, which was just over $2. But if you get more, great. Now, the key to why we are doing this, because a lot of people would say, well, why aren't you getting MSTY? And the reason is on Robinhood margin. Let me explain. Because margin maintenance is very important to our strategy of investing. Now, PLTY has a margin maintenance of 25%, whereas MSTY has a margin maintenance of 70%. Now, these numbers are current and may change in the future. You need to always remember that and watch. But because we take and have these funds, we collect our distributions, and then we use margin against this portfolio to sell options, you want to have as much buying power as possible. That means the lower the margin maintenance number, the higher amount they're going to let you borrow against those assets, which means more money to produce more income. So it's simply just a way that when it looks at it, like say it's like a bank and it's looking at these stocks, it goes, on MSTY, we can only borrow you 30% against the value of it. But the same bank would look at PLTY with its 25% margin maintenance and be like, we can loan you 75% against the value of that. So you see how you get more buying power to be able to do more things? It's just a way to increase the yield. By buying more Plady shares with the CONY dividend, we are actually still growing our account essentially, as well as getting at a low margin maintenance to allow us to make even more money. It's very complicated. I know a lot of people fully still don't understand our strategy, and maybe it's not strategy for everybody, but it's what works for us. Now, I will say that as we start to crest a certain line, we have to think about tax efficiency. We are looking at stopping once we get to about 500 shares of Plady, and then switching over to something like QQQI that's more tax efficient. But at the current moment, it allows us to take our worst investment at this time, which is CONY, and take it and move it over to something that's actually performing better currently, that will help us maintain our yield that we want, as well as grow our portfolio and give us good margin maintenance. Now, quick word, when you're dealing with single stock ETFs, I don't care whether it's covered call strategy or other strategies, you have to be careful because unlike safer funds that are based off indexes or that have multi-stock categories, all in one, or even sector, all right? Every time you cut it down to smaller and smaller, whether it's full-on index to sector to just a basket of stocks, every time you do, the risk goes up. A lot of times the reward goes up, but every time the risk goes up. So when you're talking about a single stock ETF, you are relying on that stock or that underlying to do well long term. All right, so the odds of you having one that doesn't do well is much higher no matter how much research you do. So in the long term, I definitely think that it shows how indexes, which they call self-cleansing, are nice because they basically push all the bad companies out as they go down in their market weighting due to financial problems or other things. It definitely will put you in a safer environment to deal with things that are not single stock ETFs by staying more index or a basket of funds. Now, I will say that our portfolio kills it in my opinion. I mean, other people are obviously doing much better than us, but we are hitting all our goals. So the diversity comes from the fact that we do multiple different things in our portfolio, from selling options to the distributions to our safer assets that we have paying distributions. And it all balances out to making a very nice living off one very small basket of money. I can't complain about that, but I'm also not going to try and sit here and act like we don't have losers in our account. If you look at our whole account, we're growing every single day. Every account we have is growing, doing well. If you look at the yield on cost based on portfolio, we're making plenty of money. Our numbers come out every single month. And granted, those are all numbers before taxes, before, health insurance, before our bills. So those are very raw numbers. But you can see we are profiting every single month. All right, so that means our portfolio is a winner in the overall. But I'll stand right here and make this video and tell you this one's a loser. This one's not doing good. And I'm showing you how we're fixing that. And honestly, in investing, this is the kind of decisions you need to be making. I see too many people that are just like, put it all in one single stock ETF and just expect that it's going to be okay over the long term and never try and change their strategy once it's started. And that's very, very dangerous because it only takes one piece of bad news, one thing to change, and a single stock ETF can fall through the floor, literally. And sometimes, like we've seen, some of them don't recover. We've seen multiple ones that have reverse split and still are not recovering, falling through the floor. So be smart with your money. Do your research. Think about diversification. And don't be afraid to admit your losses and then think about what's the best way for you and your strategy to deal with those losses. You'll be glad you took the time to find a solution. And with that said, if you haven't already, please go down, hit the subscribe button. And with that said, I'll see you in the next one.